This is the second video that I'm going to do on A2 marketing. The section that we're going to be looking at is chapter 8, page 54 of the textbook. I'm going to be using some of the data from the textbook, so it's worth having it open in front of you if you've got it. This is the AQA book. So these are the key kind of elements of the video here. Firstly, we need to consider why a business would analyse the market. So what essentially are the benefits of market analysis? We've then got these three methods of analysis which we need to know. So these are basically simple statistical methods that we can use to try and predict what's going to be happening with the marketing. We also need to understand the difficulties of performing this sort of analysis, both in terms of actually getting accurate data to begin with, and then in terms of the challenges faced when trying to deal with those three techniques. And finally, we also need to think about the impact of technology on market analysis. The advent of technology and mass amounts of data has meant that the way that companies go about doing this has changed quite significantly over the last few years, and we just need to say a few words on that. Market analysis is a really important thing for the business to do. This kind of sits alongside the topics that you did at AS, primary and secondary market research. Market analysis is then what you do with the data that you generate as a result of the research that you have done. So some of the things that you might want to kind of think about, and again, if you think of kind of the questions that they ask on Dragon's Den, you won't go far wrong with this. So things like the size of the market, okay, and also the growth of the market are really key aspects that the business will need to consider. Obviously, the size of the market is important. You need to know that that the market is big enough to sustain a business, and growth of the market similarly. You know, the business will want to be involved in a market that has some potential for development in the future and for kind of future profitability. So why would we actually look at these things? Well, mainly this relates kind of back to what we saw in the previous video with the objectives. So what the business is trying to do essentially is it's trying to gather evidence for a new strategy. Okay, so if we think kind of A2 is all about this strategy, and whenever the business is going to adopt a new strategy, it needs to think about the markets and the customers and so on. It needs to think about those aspects that we were talking about in the last video, things like the actions of competitors, technology, market conditions, and so on, things like that. So that's the first thing that that it will do. And the second thing is kind of related to it, but identifying trends. Okay, so most of the methods that we will be looking at here are to do with trend analysis. So once the business has gathered its information, it then needs to actually figure out what the underlying trends are, and that's where the tools that we're going to be looking at in this video come in. So moving averages then is the first of these. Okay, so a moving average, basically the intention of a moving average is that it aims to eliminate short-term variations. So some businesses, think about kind of any businesses involved in the tourist trade and so on, things like that, they will be very influenced by seasonal fluctuations, and obviously it needs to try and kind of smooth those seasonal fluctuations out to try and figure out the overall trend. So what the moving averages aims to do is it aims to try and identify the what we call underlying trend. Okay, so if something is going up or down over the longer term, not just based on short-term fluctuations. So on the next slide, I'm going to actually run through an example which is given in the textbook on how to actually do this. So In order to work out moving averages, I'm going to use this data, which is taken from page 56 of the textbook. It's arranged in a slightly odd way, in that you kind of read down the first column and then down the third column and then down the fifth column. But if we just focus on the first column, so year/month, so what we can basically see, the key thing to draw out from this, despite the poor kind of arrangement here, is that if we look kind of down at these two values here, okay, we can see that the retail sales are larger in these 2 months than they are in the other months, and in the second of them particularly. If we look more closely, we can see that these are November and December. So, as we would expect, retail sales peak in the run-up to Christmas. They then fall away dramatically in January and then stabilise through the rest of the year. Now, obviously, this provides quite a seasonal pattern, quite a volatile pattern, and it's difficult to draw out from that the underlying trend of this data in terms of whether UK sales are rising or not. So one of the tools that we can use, as we've said, is moving averages, and a couple of ways which I'm going to talk about doing that. First of all is what we call a quarterly moving average, which is where we take 3 values. The other one is a 6-month moving average, where obviously we take 6 values. So for a quarterly, first of all, okay, what we do is we take 3 months, okay, being a quarter of a year. We take 3 months and we average those out, okay? And when we do that, we get the average value of 119.9 for those first 3, okay? So that then becomes our average value for July 2006. We put it in the middle of them, okay? What we then do is we then average, I'll do it in a different colour so we can see, the next 3. So 2 of them overlap, but now we include this value as well, okay? And that brings 119.1 as the average for August, okay? We then do the same thing again for the next 3 values. So we now take August value, September and October, we average them and we come out with 120.3 as our moving average there. So what we're basically doing by doing this is we are smoothing out the trends. Okay, now the alternative to this, as I mentioned, is that we do a 6-month moving average, okay, which shouldn't take all that much to figure out exactly what we're talking about. For a 6-month, we take kind of 6 months worth of data. So if I do that in the second column here, so what we do is we start here and we take 1, 2, 3, 4, 5, 6 months of data, okay, and then we average all of those values out to get the kind of the central value, okay, and if we have a look, that gives us that value as being 123.1. Okay, so that's our 6-month moving average, and basically what we're aiming to do here is we are aiming to smooth out the trends. Okay, so what we are aiming to end up with, if I just bring this, no, not that. Go back a little bit then. Okay, if we bring this data a little bit to the front here, we can see what we've got there is the raw data. That's the data from the table is seen in blue. Hold on, if I just shrink this out of the way a little bit, and I can make this a bit bigger and we can see what we're dealing with. Okay, so the raw data is the blue line, and you can see there the massive spikes that we get in the Decembers, and then the big fall in January that we can see from the raw data. The red line then is the quarterly moving average. You can see that we've smoothed out the trends there. The spikes are nowhere near as erratic. So that gives us a slightly more identifiable trend. And then we've got the yellow the yellow points, which indicate the 6-month moving averages. And you can see, again, that's a smoother line still. Now, we're not actually changing the trend here. The trend has remained the same throughout. What we are doing is we are making the data closer and closer to the trend. Why would we do that? Well, first of all, to make the trend more clearly identifiable. which means then it becomes easier, for instance, when we want to extrapolate, which is what the next slide is all about. The danger, of course, by doing this is that we actually hide detail, which may be very important to businesses. By smoothing the lines out like this, we are hiding information. In this case, we're hiding the fact that November and December are very strong times for the business. Now, if we think about that in terms of, say, business cash flow, hiding that information is actually not beneficial. So you've got to draw a balance with the moving averages between making them smooth enough that you can identify the underlying trend, but not so smooth that actually you remove all of the useful information. So it's a bit of a balancing act about how we use them, but essentially we are just doing a very simple average here of adding up the number of values and then dividing them by however many there are. So your standard mean average calculation. So for the 6-month moving average, I took 114.7 plus 119.7 plus 123.8 plus 123.4 plus 124.6 plus 124.7, all of them added up and then divided by 6, which is how many values there are. So a simple kind of average calculation, mean calculation, and then you can see in the chart on the right what that actually does in terms of smoothing out the data. Once we've used our moving averages technique to smooth out the short-term fluctuations in any data that we receive, what we may well then want to do is extrapolate that trend into the future. And extrapolation basically means where we continue past data to predict the future. Okay, so it's obviously a very important technique for businesses because being able to predict what will happen in the marketplace 6 months down the line or a year down the line is really important if they're going to make good strategic decisions in order to take advantage of that. So I'm just going to use an example based on data that we already saw, the real wages data. So if we just bring this chart up here like that, okay? So this is the real wages data that we had a look at before, okay? And what we can see is that we may well find our moving averages or our trend line, okay, which runs kind of through the middle of the data. So let's say that our trend line is broadly that, okay? So that's the trend that we have based on existing data. Okay, that's our trend line. When we smooth out the volatility there, we can see that actually there is a trend improvement in real wages over time. What extrapolation means is what happens if we continue this into the future. Okay, so we consider essentially that obviously all of this area here is the past. Okay, this is data that has occurred. This point where we are right now, okay, that is the present. Okay, and what we are doing then is with this bit of data here, okay, we are trying to predict the future as a result of a continuation of this previous trend. It's a very simple method, but can be quite effective in terms of coming up with kind of relatively simple projections about what will happen down the line. Okay, so as with everything in business, we need to look at the pros. Okay, and the pros of this are essentially to do with developing strategies. Okay, so when we know what's going to be happening in the future, that enables us to make better strategies. So for instance, in terms of our HR, making sure that we have the right people in the business, in terms of our budgets, okay, and our financial strategies, it's important to know how much we will be selling. Also, obviously, for our production planning, okay, and our logistics, it will be really important to know what the future sales are likely to be, okay. Disadvantages, though, the main one is it relies on past data, okay? Now, that is a problem. If the market is rapidly changing, then it means that relying on that past data is not necessarily going to be an accurate prediction of what happens in the future. If it's a stable, slow-moving market that doesn't experience massive volatility, the textbook gives the example of dental care, then it may be a valid way of doing things. But if it's, for instance, kind of a technology market or something like that, you're not going to be able to do this extrapolation. And obviously, the further into the future you go, the less reliable these, beg your pardon, spelling mistake there, the less reliable these predictions actually become. Okay, so when we are thinking about these extrapolated trends, okay, again, as with a lot of things in business studies, it comes down to the nature of the business. Do they exist in a market which enables extrapolation to provide an accurate prediction of the future? If it's a stable one, then it might be useful. If it's a volatile market or a changing market, then it's going to be not so useful. And again, we also need to think about how far into the future are we relying on this extrapolated data. Another factor we need to think about with any sort of data is the correlation. And the correlation is the strength of the relationship. Okay, so when we look at two things, we need to know how strongly related they are. That will help businesses, for instance, identify the key factors which they should incorporate into their strategies. Okay, and there are three basic forms of correlation. Okay, there is positive correlation, there is negative correlation, and there is no correlation. Okay, positive correlation means as one thing rises, the other thing rises. Negative correlation means as one thing rises, the other thing falls. And no correlation obviously means that there is no relationship between them. So let's just have a look at a few quick examples just to demonstrate that. So this is an example of positive correlation. Okay, so positive correlation, we have our two variables, the grade and the hours studied. As we would expect, the grade gets higher as the hours studied improve. As the hours studied go up. So you can see that these points are clustered around a generally upward sloping line, which means that this is a positive correlation. A negative correlation, on the other hand, as you would expect, is when we have a downward sloping line. So if we take grade against beers, then we have, as you can see here, them cluster around a downward sloping line. The more beers you drink, the worse your grade becomes. That means that there is a negative correlation between those two things. The final sort of correlation, oh, goodness me, what's going on here? No, that one over there, that one over there. The final sort of correlation is no statistical relationship. So, for instance, if we were to plot grade against toe size, I'm not saying we would get a perfectly round circle like that, but we would get points all over the place because there's no correlation between those two things. So, from a business point of view, if they are positive or negatively correlated, they are important. If there is no correlation, then they are not. You may also notice here that we have these numbers on the charts. Okay, these numbers refer to basically how strongly correlated they are. So not just saying positive or negative, but also how strongly positive or negative they are. This exists on a scale from -1 to +1, and the closer you get to 1, the stronger the relationship becomes. So we can see here, I don't know where my line has gone, but anyway, put it back. The positive correlation between hours studied and grade is strong. We know that because the points are all very close to that central trend line, which means that the correlation coefficient, which is a fancy term for this, is 0.89, very high, very strongly correlated. If we look at the beers drunk, we can see that although there is a clear downward trend, the points are further from that line, which means that the correlation coefficient, first of all, it's negative. That's because the line slopes downwards. And it's 74, so it's not as strongly correlated as the hours studied chart was. So the correlation then is very important because it enables the business to think about what it needs to do. So some examples, for instance, of things we expect the amount of advertising and the amount of sales to be positively correlated. We would expect the price and the amount of sales to be negatively correlated. Establishing the strength of those relationships enables the business to see how much focus they should put, for instance, on advertising as opposed to price cuts, because they will be able to look at the strength of the relationships and say, right, well, the relationship between advertising and sales is much stronger than the relationship between price and sales, so we should spend our money on advertising. That will be a better way to boost our sales. So understanding correlation, the strength of the relationship between these two things, is a very important thing to do. One other thing, though, that I do just want to mention very quickly, okay, is that correlation doesn't necessarily mean causation. Let me just pull up another example here to show you what I mean by that, because it's a very kind of common mistake to assume that simply because there is an apparent relationship between two things doesn't necessarily mean that that relationship is what we call causative, that one thing actually causes the other. And obviously, if it doesn't actually cause the other thing, then it's not really important. So if I just put this over the top of the notes so far, you can see that this shows that the per capita consumption of cheese in America correlates very strongly, okay, as we can see down here, okay, we've got a correlation of 0.95, that's a very significant correlation. It correlates very, very strongly with the number of people who died by becoming tangled in their bed sheets. Obviously, well, not obviously, but we would expect there is actually no relationship between these two things. So it would be a mistake to say that reducing the consumption of cheese in America would reduce the amount of people who died by becoming tangled in their bed sheets, because this is a coincidental relationship, not a causative one. There is no cause and effect relationship here. So you just need to bear that in mind when you consider correlated data, that even if there appears to be a correlation, one of the things you should always evaluate that on is, if I just move this out of the way, okay, is it causation or coincidence? Okay, causation or coincidence. If it's a causative relationship, it matters to the business. If it's coincidental, it doesn't. So it's important for a business to also consider what is difficult about this sort of data analysis. In some cases, it's to do with difficulty. In some cases, it's to do with problems that they need to be aware of. But a lot of these are kind of similar to the things that you would have looked at last year. So one of the kind of key considerations to think about here is primary or secondary research. Okay, and again, you should have looked at that a fair bit last year in terms of kind of the impact of it. So you should know, for instance, that primary is generally more reliable, or well, not more reliable necessarily, but more specific to that business's needs, but more expensive. Secondary tends to be more general information, less specific to that business, but because it's secondary, it's already available, it's cheaper. Now, a couple of kind of new terms really. So within the primary, one of the things that you need to be aware of is kind of trying to use a test market, which is basically where you do a small scale launch of a particular product to assess the likelihood of success on a bigger scale. The difficulties of this are very similar to sampling, actually. So this, what we're basically talking about here, is a sample. It's often a geographic sample, but it's subject to the same sorts of problems. So you need to be thinking about, for instance, whether the area that is chosen for the test market is representative. Probably not if you're thinking of overseas expansion, for example. Also need to think about, as we were talking about in the previous slide, kind of how competitors are likely to respond and the wider market activities, social changes and trends and so on, things like that. All of these can influence the effectiveness of the test market. Kind of otherwise within the primary market research, we kind of have the similar kind of issues, I suppose, that we have been talking about throughout. So the key issues are that it is based on historical data. Okay, so if we as a business go out and we look at historical information, what's called back data, sometimes. So we'll add that on, what's called back data. Okay. Now, there is nothing which specifically says that trends identified in back data will continue into the future. So business always needs to be quite careful about how it uses this back data. We also need to be aware of bias within the data. Okay, so for instance, are the sources that we get, do they have any interest themselves in serving us figures that might be too high or too low? And we also need to think about the fact that reliability gets weaker the further ahead you go. All right, we've already looked at this idea a little bit in terms of investment appraisal, the idea that the further into the future you go, the less and less reliable the data that you receive becomes. So those are some key aspects. Again, as with everything else in business studies, really important that you look for the circumstances of this business in terms of the actual internal workings of the business, but in this case particularly the market in which they operate. That's going to be a really significant thing to consider. Now, another thing that we need to consider is how technology has affected data analysis. So we don't actually need to look into this in a huge amount of details according to the specifications, but it's actually a very kind of big issue for businesses at the moment is dealing with data, because the nature of data has changed a great deal, and technology enables it to be processed much more quickly and in much more detail. So one of the kind of the advantages, I suppose, is the speed of processing. Okay, so data collected, for instance, from an EPOS, FPOS type system, that can all be processed really kind of in real time, which obviously enables the business to respond to it more quickly. Also, the volume of data which can now be collected and processed is far larger than it used to be. And businesses actually can now integrate their data much more effectively to build up effective customer profiles. Disadvantages of data: the main one is kind of information overload, really, that there is so much data out there, it can be difficult to find the actual trends, the actual useful bits of information in amongst all of that kind of data noise. It's what's called at the moment big data, and a lot of companies are struggling to find out how to use this effectively. And another thing that we need to be aware of is that kind of obviously having data available very quickly and analysis available very quickly might lead to excessively short-term decisions being made, essentially kind of reactive decisions. So people may think, for instance, that data demonstrates a particular trend, which has been demonstrated because of the very rapid way in which it's been processed, but actually, for whatever reason, that may just be a bit of an anomaly. So the strong managers will not let this happen. So again, this is yet another example of where you need to draw out of the case study whether or not the managers demonstrate kind of strength and commitment to an idea and thoroughness of research and so on, or whether they are a bit more impulsive and reactive. Because there is a danger with very, very rapid access to very large amounts of data that actually they may become excessively compulsive and they may jump very, very quickly into decisions which actually are not beneficial. So what we've done there then is basically we have run through a few key aspects of how businesses can use marketing data. Importantly, you probably won't have to calculate any of these in the exam, but you need to be able to interpret the numbers which are there. So you will be given a table of data and you will be asked to interpret what that information shows. Obviously then bearing in mind the pros and cons of the various methods as we've discussed, but also crucially the circumstances of the business itself.